Let's look at our first handout and see what we can come up with here. Says, using accrual accounting, revenue is recorded and reported only, and then we have 4 choices. When cash is received without regard to when the services are rendered, when the services are rendered without regard to when cash is received, when cash is received at the time services are rendered, and if cash is received after the services are rendered. Okay, so just a little bit of a review. We are using accrual accounting, and what we're testing here is the concept of revenue recognition. Okay, that's what we're looking at. And in accrual accounting, we say that we are going to record revenue when we have earned revenue. So looking at choice A, it says when cash is received without regard to when the services are rendered. This will be incorrect, because if we're just looking at when cash is received, we could receive cash before it's actually earned, right? We call that unearned revenue, and unearned revenue is a liability. So A is going to be wrong. B, when the services are rendered without regard to when cash is received. So we need to understand that when services are rendered, at that point in time, revenue has been earned. So you might make a little note, not that you're going to see the word rendered a lot, but when we say that, when we say rendered, it's the same thing as earned. And this is the accrual basis of accounting here with choice number, or choice letter B. Don't get me wrong, we want to receive this cash at some point. And, 99% of the time we will. But under accrual accounting, we're going to record revenue when we've earned the revenue, not when we receive the cash. If we did it this way, if we only recorded when cash was received, that would be the cash basis of accounting, and that's not what U.S. GAAP wants us to use. I think I may have given you an answer to one of the questions on this page just now, if you were paying attention. Using accrual accounting, expenses are recorded and reported only. Okay, so this is testing expense recognition, or the expense recognition principle, also known as the matching principle. May have given you another answer just then. Let's see here. When they are incurred, whether or not cash is paid. Okay. When they are incurred and paid at the same time, if they are paid before they are incurred, and if they are paid after they are incurred. Okay. So let's think about this. Choice D is kind of a nonsense answer, but I do want to look at choice C. If we're paying an expense before they are incurred, that's a prepaid expense, which is an asset. So D and C are both wrong. B, when they are incurred and paid at the same time. Well, if this was the case, then we would be missing a lot of our expenses, because we would only record the expenses that we pay for at the time they're incurred. So that's kind of a silly answer too. Looking up here at A, it says when they are incurred, whether or not cash is paid. So when we incur the obligation to pay, that's when we record the expense under accrual-based accounting. So letter choice A is the correct answer. Generally accepted accounting principles require accrual basis accounting. This is absolutely, positively a true statement. Okay? Now I want you to understand that just a little bit of a word here. I have probably prepared 5,000 tax returns at least in my life, and many of those had small businesses and so forth. and those taxpayers use the cash basis of accounting. So what I want you to understand here is that GAAP, generally accepted accounting principles, is not equal to tax code. Okay? They're two separate things. Moving on. Even though GAAP requires the accrual basis of accounting, some businesses prefer using the cash basis of accounting. This is a true statement. And you could even, let's see here, you could even replace this word some with the word most if you wanted to. Small businesses account for most of the businesses, and most small businesses use the cash basis of accounting. Okay? Because they're not, they're not publicly traded companies. They're privately owned. And with the exception of construction businesses, most small businesses are not subject to GAAP. Okay, so in this class, I probably should have made a bigger point of this. When we talk about GAAP, and really when we're talking about anything in this class, we're really referring to companies that sell stock, okay, to the public. Next question. Is the accounting principle on which deferrals and accruals are based is what? 4 choices: matching, cost, price level adjustment, and conservatism. Okay? Well, I have not mentioned choice C at all. I may have mentioned conservatism back in chapter 1. We have talked about the cost principle, but this cost principle relates to how we record assets. So what we're looking for here is the matching principle, also called the matching concept. So the matching principle and matching concept, these are the exact same things. Okay, I prefer matching principle, but I know for a fact that you will see matching concept out there, so probably need to mention that those are synonyms. Let's see here, move this up a little bit more. Okay. Let me also circle matching. All right, prior to the adjusting process, accrued revenue has been earned and cash received, been earned and not recorded as revenue, not been earned but recorded as revenue, not been recorded as revenue but cash has been received. Okay, I'm going to work through these backwards. Not been recorded as revenue but cash has been received. This is an example of unearned revenue because the cash has been received as a liability. Okay, and we call that by definition a deferral. We're going to defer recognition of this cash until it has been earned. Okay. Choice C, not been earned, but recorded as revenue. Well, it has been recorded as revenue, but it's the exact same thing as we have here. This is unearned revenue, which is not the same thing as regular revenue. Again, this is a liability, and it is also a deferral. Choice B, revenue has been earned and not recorded as revenue. this is going to be our correct answer. But remember, we're using the accrual basis of accounting. So we accrue revenue when it has been earned. So what we're referring to here with this question is a timing issue. We had that example, where the company got to December 31st and they looked at this contract, Net Solutions they did, and they found that they had performed 25 hours of service. I think they were billing it at some really small amount, like $20. So they said, okay, well, looking at our billing sheets, we have earned 25 hours at $20 an hour, and that's $500. So they had earned $500 of revenue, but they hadn't recorded it yet. And then they, as part of their adjusting process, they went ahead and recorded that and set up an accounts receivable for that $500. So that's the exact same thing we have going on here. Okay, let's look at what we have here. It says a company receives $6,500 for 2 season tickets sold on September 1st. If $2,500 is earned by December 31st, what is the required journal entry? Okay, so when they receive, what we're saying here is that on September the 1st, when they received this $6,500, they had earned $0. But, let's see here, 4 months later, they've actually managed to earn $2,500. So I want to show you two things real quickly. The first thing I want to do is answer the question. But I also want to show you the way that this would have been originally recorded so that you can see why the correct answer is correct. Okay, so the correct answer would be revenue. Well, I made a mistake here. I need to space this out some a little bit better, and I need to drop it down too. The answer is unearned revenue, and revenue for 2,500 and 2,500. Okay, and this is our answer. All right, this is what they're looking for, because initially our entry was this. Now, let's see. I'm going to run out of room here, but we can do this okay, I guess. So our original entry, we received cash of $6,500. Cash is an asset, so it has to go up with a debit. And then we correctly recorded unearned revenue as a liability for $6,500 with a credit. See how it's over here to the right? Then when we earned it, we had to back that off by $2,500. So we did that with a debit to unearned revenue, okay, for $2,500. So if we were to look, the cash, we already had the cash, okay? So now if we were to look at our financial statements, we would see a $2,500 addition to regular revenue over on the income statement. And then if we were to look at our balance sheet under unearned revenue, instead of showing a $6,500 liability, it would now show how much? $4,000. That's the $6,500 minus the $2,500 that we have debited off of that liability. Because remember, all liabilities have a normal credit balance. So by debiting it here, we lower the liability. One more question, and then we'll wrap this video up. If there is a balance in the unearned subscriptions account after adjusting entries are made, it represents what? Now this is kind of a tough question here, because you know, if I was taking this and I was taking a test and I read this question as a beginning accounting student, You know what I would be looking for here in my choices? I would be looking for liability. Okay? And it's not there. Because the portion of unearned subscriptions that remains at the end of the year is a liability. But that's not all it is. So let's go through here and see what it is. It's not a revenue, not in the, I mean, it's unearned revenue, but that's not what it is because it's a liability. It's certainly not a dividend. So is it a deferral or is it an accrual? Well, let's think about this. We are waiting or deferring the recognition of that unearned revenue to count it as an actual revenue. We haven't counted it yet. So we are deferring the revenue recognition. We are deferring revenue recognition. That's what we're doing here. Don't be fooled. I really don't care for this choice here, choice D. That's confusing to you because unearned revenue has the word revenue in it. But the correct answer that we're looking for here under this circumstance is that it is a deferral. It represents a deferral. All right, that was a lot of time for a short handout, so let's wrap this video up and move on to the next one.